Okay, good afternoon, everyone. Thank you for joining us for another one of our WESK webinars. My name is Josie, and I am WESK's marketing advisor. For those who don't know, WESK's purpose is to help women entrepreneurs in our province succeed. We offer a variety of services to help you start, grow, and scale your business, such as business advising, financing, events, and of course, training like today. For those who don't know as well, we are offering free webinars every Wednesday on a variety of different business topics for the rest of 2020. Also, for a limited time, we are accepting applications for the WESK stream of the Regional Relief and Recovery Fund. So if you've been negatively impacted by COVID-19 and you've been ineligible for other government support programs, we are here to help you, and we have loans of up to $40,000, and these are available through this program. So I will go ahead and I'll post a link in the chat with more information on that program if you're interested. Okay, so today's presentation is the first part of our Learning Month with Deloitte webinar series. So for the month of October, we'll be hosting an accounting-themed webinar every Wednesday with our friends at Deloitte. Our first topic is break-even analysis and is presented by Peter Versfeld, who is a manager of Risk Advisory Department at Deloitte. If you have any questions during the presentation, please make sure to use that Q&A box, not the regular chat box. So there's the Q&A where you can throw in your questions as we go. And then there is a chat box where you can just feel free to interact with attendees, share some info about your business and whatever else that you want to share. And as always, this webinar will be recorded and it'll be available for on-demand viewing at wesk.ca. You'll also receive an email tomorrow at this time with a link to that recording, so keep an eye out for that. All right, with that, I think I'll hand it over to you now, Peter, to begin the presentation. You can start whenever you're ready.
Awesome. Thanks so much for the introduction. Hi, everyone. So while I figure out how the screen share works again, give me a second. Just want to confirm if you're able to see my screen.
Yeah, that looks good, Peter.
Thank you. So what I thought maybe just with everyone kind of working remotely and just with everyone sort of, I guess, craving some interaction, I do want to keep this session as interactive as possible. That's why you'll see as part of the handout that was sent out earlier, there's an example that I want to kind of work through, and then I kind of want some feedback and responses as well from the process. So maybe as a start, I'll just give you sort of a brief history, sort of my role and everything, and then kind of get some questions from you guys as well. So my name is, as Josie says, Peter. I started with Deloitte, I think it's been 9 years now. I was in external audit for a few years, then I moved into our risk advisory department, which focuses mainly on internal audit, some controls, and sort of process improvements and efficiencies. So what I'm maybe going to ask if there's a few people that would be interested in sharing sort of the nature of the businesses that they're in. And mainly I'm looking just to see if you're in manufacturing or if it's more retail or service focused. It's kind of what I'm trying to just judge. If you wouldn't mind sharing that in the chat box. Okay, so there's a few. Some retail, some service industry. Okay. Awesome. So the reason why I just want to see kind of the scope of what we have here is this break even might be slightly different depending on the industry that you're in, because I think typically if you look at break even, the typical thing that comes to mind is I make a product and I sell a product, but break even is still applicable to your service industry and your other industries too. So maybe as a start, what I wanted to find out from you is, what does break even mean? Or I mean, even going as far as, what does break even mean for you in some ways? If you guys have any sort of responses or comments on this. Yep. Yep. But you guys are right. Break even is um, basically that balancing point where you no longer make a profit or a loss. Yeah, you guys are perfectly spot on with that. So it's basically that sort of crossing point where you start, hopefully move from where you go from position of making a loss, where you move into position of making a profit. So what I wanted to run through was maybe just sort of a different components of a break-even analysis, and this would have been included in your the handouts that were sent out, just sort of key concepts that you'll see sort of recurring throughout the presentation today. So the contribution margin is effectively the profit that you'll be making per product. It's the contribution that the profit that you're making on each of your products contributes to your bottom line. So, and then obviously, moving into the different costs, we have obviously we have fixed costs and variable costs, and then some examples that I do want to show, and then I'll make some reference to the handouts to just from the graphs. But what I want to maybe run into is just some examples on what the different costs are, and what maybe have a look and see if you guys can make out whether these costs would be considered direct or variable. So when you're looking at direct materials, would you consider this to be a variable or a fixed cost? Okay, so maybe taking a step back, the difference between no, direct materials would be anything in any costs or any products that you use in manufacturing in your process. So, for example, if you are doing manufacturing, it would be, like you said, it would be the metal in manufacturing or steel. Or if you have a retail, it would be the cost to produce those retail products. Um, Typically, direct materials would be a variable cost because the cost would fluctuate based on the production. Because if you have let's say, for example, if you're constructing tables, um, yeah, it's based on the number of the unit of sale, well, the unit of production and then the unit of sale as well. Um, so if you have a table that you're manufacturing, if you manufacture 5 tables, the amount of wood would be whatever the wood cost would be for 5 tables, but that would increase or decrease based on the number of tables that you're manufacturing. The next one was rent. Would rent be a fixed or a variable cost? Yep, you guys are right, because whether you manufacture 5 tables or manufacture 10 tables, the rent that you'll be paying on your property would stay the same irrespective. I mean, there are certain elements, and we'll explore different costs later on, because I know in some of the retail spaces, in some of the malls and the shopping centers, there's an element where they incorporate a variable component to the cost, but that would be very unique or specific to certain areas. Um, Sales commission, would that be a variable or a fixed cost? Yep, that's right. That's definitely a variable cost, because again, depending on the number of products being sold, that would determine the amount of cost that you'd be incurring on those. So just what I wanted to share here is, so this is sort of a graphical representation of how a variable cost would fluctuate. And I think for me, I tend to work with pictures. So the graphs help for me. So what this is basically saying, when you have no units being produced, the cost would be 0. But as soon as you produce 150 units, the cost would increase, and it would increase depending on the production. While if you look at something like salaries, where typically salaries would be a fixed cost, no matter how many units you produce, the cost is going to stay the same. So for me, like I said, it's just sorry to jump between the two, but that's just to kind of, and that's what I tried to capture when I looked at when I put the handout together, was just to kind of share the difference between like the graphical representation of this is what the variable cost looks like, this is the fixed cost. It's just to show you, like the variable cost would fluctuate based on the units produced, and then the fixed cost stays the same no matter how many you produce. Was there any questions so far before we run into the, I'm going to call them the slightly interesting costs, variable costs and stuff that you have? Okay. So what you can run into is a situation where you have mixed or semi-variable costs. So you would have something like utilities where there would be a fixed cost because you're paying for the use of that facility, and then you would have a usage cost associated with that as well. So when you're looking at the key thing when you're doing a break-even analysis around the cost would be looking at it and saying, well, what is the nature of each of these line items? Would this be fluctuating based on use, or would this not be fluctuating? So if it's typically your connection fee or your fixed fees and stuff like that would be your fixed cost. And then, for example, your variable cost would be the usage for that. So the question here is, I was wondering, given that sales commission is a guaranteed percentage, if it's not a fixed variable cost, it would be a fixed percentage. However, it would be dependent on the number of sales. So if you only sell 5 units, the cost would be, let's say, 10% of the 5 units. But if you sell 10, then obviously the commission would be higher. So that would be a that would be a variable cost. So and that's why they say with salaries with commission would be a mix, because the salary would be fixed, but the commission portion would be variable. Okay, the only question that there was the question was just around, there was only the one question was around whether sales commission is a guarantee, because it's a guaranteed percentage if it's not a fixed variable cost. And then the answer to that was just that it wouldn't be, it would just be a variable cost because it's based on, it fluctuates based on the number of units sold or produced depending on the scenario that you're looking at. So the next kind of cost that you don't typically see these a lot would be the step costs. So what this means is that if you have a factory set up, and this factory can manufacture 100 units. If you need to manufacture, let's say 200 units, in which you need to get additional factory space, then that's what this represents. It says your cost would be fixed. Sure. Thanks, I'll do that. So for the step cost, basically, when you produce at a certain level, that cost would be fixed given that production level. However, once you require that second factory space to produce the additional 100 tables, that would push you into a second tier of fixed cost. So I know the step cost is a bit of a weird concept. Like typically you don't see this. Most costs are often very much either fixed or variable, or sort of a combination of the two. I don't know if anybody had any specific questions on this one. Okay. So as we mentioned before, the contribution margin is the what is contributed to the net income of the business. And it's basically calculated by looking at the difference between the selling price per unit and the total variable cost per unit. So in the example, and this is maybe where I would like you to follow along on the breakout, on the handouts that I sent through, because I would like us to kind of just go through this calculation and kind of explain through it. And if you guys have any questions from the calculation, we can, or the workings, we can go through that. So just give me a second. I'll make the screen bigger in a second, just to make sure that everybody can still see my screen. Okay. So the first step that I would, when you're calculating break even, and the contribution margin, what I would start with is I would look at, break it down and say, what's the costs involved. So the first step, I know the example that we've mentioned here is that I manufacture t-shirts at a factory. The cost for the year is 50,000 for rent, 20,000 for materials. So when I say materials, that would be in this case, it would be fabric, but I mean, it could be any input. It could be commissions. You could see it as any other variable cost from that perspective. Manufacturing wages, and then it says, and then for this scenario, it says, I made 500 t-shirts and I sell each shirt for $100 each. And then what is the contribution margin? So what I wanted to maybe work through, sorry about that. What I wanted to maybe work through in this example was just to kind of go step by step what you would do when you do this calculation. So the first step to look at is to understand, would you say rent is a fixed or a variable cost? I know we've kind of said, I kind of give the answer away in the example above already, but so the rent in this case would be a fixed cost. So you remember from the contribution margin calculation, it's the difference between the selling price per unit and the total variable cost per unit. So the idea here is to identify which ones would be fixed cost and which one would be variable. So rent would be a fixed cost. So the cost per unit wouldn't be calculated because it's a fixed. Would you consider materials for the shirts? That would be a variable cost. So the variable cost per t-shirt would be to take the 20,000 divided by the 500, which gives us a cost of, if I can do maths in my head, sorry. So that would be $40, oops, per shirt. The manufacturing wages in this case would be a variable cost as well, because that's it would be the cost incurred as you produce each of the shirts. So that also would be the 5,000. Oops, sorry about that. Divided by the 500, which would be, it almost sounds like slave labor here, to be honest, but so that would be $10 per shirt. And then the other information that we have here is that shirts are sold at $100 per shirt. So looking at this, what is the contribution margin? So the contribution margin, as we said before, is the contribution that each sale makes to the net income of the business. And then it's, as we said before, it's calculated by taking the selling price per unit less the total variable cost per unit. So the variable cost in this case, as we've identified these above, would be the materials of 50 per unit plus wages of $10 per unit. Oh, sorry, that's 40. My bad. So the variable cost in this scenario would be the $50. The selling price would be, as we've mentioned before, obviously it's up top there, so that's 100. And then the contribution margin in this scenario would be, would be the $50 per shirt. So for every shirt that you sell in this scenario, it would contribute $50 to the bottom line of the company. And I know in this scenario, it's extremely simplified. I think the actual calculation is not where the complexities would come in. It would be looking at each product and understanding what are the actual costs that go into this product. So from the first step, what I would look at is I would take each product and break them down and say, what are the costs and time and things that go into this specific item to manufacture that? and then say, okay, well, then you've identified or to provide a service in that case too, and then say these are the variable costs, and then also having obviously the fixed costs at the bottom will come later, but then just focusing on the variable costs for now, and then looking and saying, well, this is my variable cost, this is my selling price for this product, for this service, or for this product, or for this item. So, and then calculating contribution margin from there. So, like I said, I think the complex part or the difficult part is actually breaking down these costs and actually identifying them, breaking them down, and then quantifying them. Before we move on to the break-even part of this, I just wanted to ask if anybody had any questions on this specific scenario. Okay. So let's see quick. So in this example, so what I just did here is I just, again, like I said, for me, in my mind, I work, like sometimes it's the images kind of gives a bit more power to the words. But this is a graph that I created saying that the fixed cost is this light green line over here. And that basically shows, as you can see, obviously, as the number of units that you produce moves along, the cost stays fixed. The dark green line represents the variable cost. The blue line represents the total cost. So as you can see, obviously, even though you produce 0 units, because there's a fixed cost element, the cost would start at 50,000 and increase as you produce them. Then the sales price would obviously also go up as the units are, as the units get sold. And basically, the break-even point is where your total cost and your sales intersect. So anything under this graph here would be considered a loss, and anything beyond this point would be considered a profit. If that makes sense. If anybody any questions on the graph with any specific concerns, then feel free to reach out. Okay. So again, it's obviously not possible to always draw it graphically when you want to calculate the break even. That's why we have two formulas that we can use. So there's two possible formulas. The one is taking the total fixed cost and dividing it by the unit contribution margin. And that gives us the number of units where it'll break even. And then if you want to calculate the total dollar value of sales where you would break even, that's calculated by taking the total fixed cost, dividing that by the contribution margin ratio. So going back to our example, so that. So the total fixed cost in the scenario, which we've already identified up top, would be the, scroll down a bit. So the total fixed cost would be the 50,000, sorry, divided by the unit contribution margin, which would be 50. So that is, I think that's 1,000 if I remember correctly. So the break-even units would be 1,000. So this is the the number of units required to be sold to break even. So just give me a second. So I'm just quickly, I think this crashed here. So the next example calculates the amount of sales required to break even. So that would be the same, similar to the other form, where it would be the fixed costs and then that would be divided by the contribution margin ratio. So how that is calculated is it's calculated by taking the variable cost of $50, oops, and dividing that by 100, which is the selling price. So it's just the contribution margin ratio in this case, and then that would be 50,000 divided by 50. So the break-even sale dollar would be 100,000. So this is the sales amount required to break even. And then also going back to the graph here, as you can see, that is exactly accurate where we've break even at the 10,000 units, and then the 100,000 would be the where we break even in terms of sales. So we need 100,000 in this scenario. We would need 100,000 in sales to break even, and then it would be 1,000 to units that would be required to be sold to break even as well. Did you have any questions on any of the costs or any of the calculations before we move on to sort of there's a few other examples that I want to show, but they won't be as in detail, just to kind of go through them as well, just give you a different scenario to work with. So the next examples, these are different. These are different examples. So when you're looking at this example, what would you say the break-even point is for this example? So we've got the formula is the fixed cost divided by the contribution margin. So what would you say? Does anybody have a so just to answer Kathleen's question, she asked, items like taxes, utilities, etc., are part of variable and/or fixed cost. I'm assuming you did not put these in here due to trying to keep it simple. Yes, Kathleen, that's correct. In a normal situation, like you would take each product, look at all the costs involved for those specific products. You would look at all the fixed costs involved in the business, and then kind of have a spreadsheet or a separate calculation to include all those costs. But yes, correct. Taxes, utilities, any costs that you incur for your business to produce these products, or see again, if it's a variable cost, it'll be attached to a specific product, but like your fixed costs would be something that you would need for all products. So if you're renting a floor space, obviously that would be a separate part, which is just the fixed costs. I hope that, so yeah, so just to answer your question, it's just for simplicity's sake is why the taxes and utilities weren't included in these examples. And like that's referring back to my earlier point that the most difficult part of this exercise would be actually sitting down and identifying which costs are incurred when you manufacture or provide certain services. And typically the one that's really difficult to identify is labor. So especially when, let's say, for example, if you think about a receptionist, do you break it down and say, if you pay her per hour, is that variable? Is that fixed? Is that, do you allocate half an hour for each massage therapy session that you host and stuff like that? So breaking that down is going to be the most complicated part. Yep. Okay. Perfect, Nita. Yeah, that's correct. That is what the break-even point is. Yep. In sales, I think as soon as you see if it's on the next example, I can't remember. I'm trying to remember if this was covered in the previous one or not. In terms of sale, that would be, yeah, it's about 150. So Manya asked, would it be 150,000 in sales? And yes, it would be it would be about 150,000 in sales to get to the break-even sales value. It's about 149,000, but I mean, for all intents and purposes, 150,000 would be right. No way, thanks, Lynn. So moving on to did anybody have any questions before we moved on to the next one? Okay, so the next one looks, so again, I think, oh, this one actually gave you the answer right away. Oops. I have to fix that cell. So again, similar to the previous one, it's just that we reduce the variable costs of each one. So the break-even units in this scenario would be only 22,500 units. So maybe something that I do want to highlight here is that when you where break even becomes an important discussion too, is sometimes you could have a decision focused around, do I invest more in a fixed cost to manufacture a product or provide a service, or do I put more, into the, or do I have a lower fixed cost and a higher variable cost? So, for example, when you're manufacturing a table, do you get a machine to do it for you? So then obviously you would have the fixed cost because you have to pay for the cost of that machine. Or do you use, I'm going to say, more hourly labor to manufacture the same product? And then obviously that decision would be impacting the amount of the break even too. So typically with a higher fixed cost, you would need a lot more sales to be able to break even, while with variable costs you wouldn't, because like the lower the fixed cost is, the lower the units are required to break even. But like again, that's what I think, that's where break even filters down into decision making in businesses where you're looking at, do I invest more from like a machine perspective, or do I invest maybe more in like hourly wages to manufacture the same product or provide the same service? It depends. So again, as you can see, the difference is as soon as you reduce the variable cost, obviously the break-even point also goes down. But if you were to increase the fixed cost, that obviously would also increase the number of units required. And then you can see here in this scenario where the fixed costs were reduced quite a bit, it effectively halved the number of units required to be sold from the previous example. So we have the fixed cost of 50,000 divided by the contribution margin of 30, and that gives us a break-even point of 1,667 units. Okay. Was there any questions like on the discussion around decision making of fixed costs versus variable? Because like I said again, it's just important to note where sometimes people ask the question, but yes, it's great to know whether I'm making a profit on selling my products, but this is quite important when you're looking at decision making on that part around, do I invest in equipment or something like that that has a fixed cost versus incurring variable costs? And again, depending on the number of products or number of services you're expected to provide, that would give you a different decision at the end of the day. Okay. Sorry. And then moving on to the next one. This is the same one. So, and then again, this is just the one that we already calculated where it was the 150,000 in terms of the break-even dollar amounts versus the break-even sales versus the break-even units. So it's the same calculation. It's just gives you a different. You would need 150,000 in sales, so sometimes you just want it in the actual sales amount versus just the actual units. Because often you don't have the sales units available, but you do have the sales amounts. So Kate asked a question around what would be required to calculate break even in a consulting services business. Kate, you would have to break where I would start most likely in that scenario is I would look at what are your fixed costs as a starting point. So for example, do you have any office rentals? Do you have any internet? Do you have any utilities, anything like that, that you use for your business. And then I would start breaking it down and saying, what variable costs do I incur on my project? So for example, um, I, I guess the question is, it depends how granular you want to get down to it, but even something as small as if you if you rent a printer as an example, and on average, again, you can use estimates and stuff like that, but let's say, for example, on average, you print 200 pages um, for your consulting business, and for that month, you had 5 projects. You could allocate, 40, um, 40 of the 200 pages to each project. Or if you're able to track them more accurately, where you say, I'm working on project A, I printed 5 pages, I drove 10 kilometers for this. Like it all depends on all those costs that you incur. That's kind of what you would have to break down. So you would need to look at what costs you incur, and then seeing how they are incurred specifically related to your consulting business. So you need to look at sort of the nature of the expenses and what drives those costs. If you incurred those costs because of the services that you're providing, then that would be considered, something that you would have to include there, and then you would have to split it out and say, would this be considered a variable, or would this considered be a fixed cost? Does that answer the question, or do you need more specific detail? Okay, perfect. Happy to chat more about it. I know, like, that's why I said in services it becomes a bit more complicated from that perspective, because you're working, the one thing we as human beings, we don't like to attach a cost to our time always. So I think that's also where it becomes different, in the sense that how do you allocate and say, for each, I mean, even somebody that, if you have a person behind, like a secretary behind the desk, or someone doing your bookings, how do you, and you charge them per hour, like how do you allocate that cost? Is that considered just fixed or variable? Your approach, I mean, some costs you could even decide and say, well, even though I pay her per hour, she has a fixed cost because of salary, because she has to be there for 8 hours every day. So then you can just allocate the cost as part of the fixed cost. Or you could say each hour is one appointment, so then you can attach 1 hour of her cost to each appointment. So you can allocate it some of them are very kind of gray, and you could allocate them differently, but I mean, at the end of the day, the impact will be the same. It'll still impact the calculation in the same way. So on this one, this was just calculating the fixed cost, the break-even sales, just based on the previous example. And again, as you can see, the sales required when you reduce the fixed costs goes down from 150,000 down to 74,000. So that just shows you and highlights the impact, the difference between the sales amount required when you have lower variable and lower fixed costs in these scenarios. So in this scenario, you have quite a very high fixed cost, and average contribution margin. But I mean, that's when, as soon as you drop that fixed cost, then the amount of sales you're required to make is quite significantly less to break even. So before we move on to this slide, maybe, was there any sort of questions that anyone had on some of the calculations and stuff? I know it's a lot of, like I says, I think the concept of break even is quite simple. I think once you start digging into the weeds about it, where you start looking at what costs should be in, what costs should be excluded, that's where it's going to get a bit more complicated, depending on your business. But so now, if anybody had any questions on the calculations before we moved on to the next piece. Okay, I'm not seeing any. Feel free to ask them anyway as we go along, but let's move on to the next one. So again, like I've kind of briefly touched on this, because so break even is critical for some of these pieces around forecasting for upcoming, saying upcoming years and months, but any sort of production planning that you need to do, because then because again, you would have to look at the demand and then understand, okay, well, if my demand for my product is 100, how can I structure my production to make sure that I get the best ratio of fixed cost to variable costs to get the highest profit margin out of that level of production. Obviously, this is a decision that you would have to reassess in the future because the demand for your product might only be on average 100 per month right now, but in another month's time or 6 months down the line, it could be double that or could be half. And depending on what that answer is, it would determine, should I be structuring my costing mix differently? Should I be putting in more on fixed costs, so for example, buying more machines, or should I be rather hiring more labor to fulfill the additional capacity or the requirement for additional capacity? It's also useful when you're planning new products. I mean, again, it's difficult to assess when you're doing new products in terms of how much demand there is going to be for it, because often we tend to be very optimistic about your products and stuff just because you're excited about something, and then it's always slow at the beginning and then kind of picks up. So it's always difficult to do this, but it's still good to plan and say, if we have this level of demand, what makes sense from a costing structure? How much should be fixed? How much should be variable? Looking at and then moving into the next piece around determining pricing structures for existing products. Say, do we have what is the nature of these products? Is it low margin, high volume, or high margin, low volume? And depending on what these answers are, will determine how you should be structuring your costs, kind of having them more on the fixed side or having them more on the variable side. Obviously, there's the budgeting element too, to kind of give you that planning and forecasting element too. Did you have any questions on this? Any specific scenarios where you could use break even? Maybe if somebody even has an example of where they have used break even in the past, that would also be really awesome. Cool. Okay, I don't see any questions yet. So I guess that's kind of the end of my presentation on break even. I don't know if you hopefully were able to follow along on the handout. If you want the answers to that, I can share that as well. But yeah, did anybody have any other sort of questions or comments or any feedback that they had? I guess any specific questions. Okay, so Kathleen asked, when one is on a set monthly rate for electricity and they are a manufacturer, I'm assuming that there would be a fixed cost amount associated with just keeping the lights on, and then there would be a variable cost associated with the manufacturing. So Catherine, yes, you are correct. Even if you look at your residential electricity, there's always that fixed cost where it's the, are you asking about the monthly surcharge from SAS Power or from the city? Or are you asking that I need at least 20 units of electricity to run my factory for each month, whether I actually produce anything or not? Maybe I should clarify first. Okay. Honestly, it could be both. I think it's a decision that you can make in that specific scenario, saying, well, no matter what I do, my bill is always going to be 500 units because that's just to whether I produce anything or not. Because I agree, sometimes there's certain things you can't switch off. I think that would depend on your scenario. Personally, I would probably put it rather on a variable personally, but I mean, there's argument to have it either as a fixed or a variable cost because it's in a way it's a cost you can't get away from no matter what you do. So in that scenario where like you have that factory production happening and you have to incur those costs, then yeah, but it's grants for both. Sorry, it's a very great answer, but a good question. Thank you. Awesome. Was there any other questions before we close out? Awesome. I'll still be on for a little bit if you guys have questions, but I just want to say thanks everyone for the great interaction and all the questions and everything. I think it was really awesome. I know break even by itself is fairly dull and boring, but I do appreciate the constant interaction and all the questions and stuff, because these are the where we kind of get into the nuts and bolts of it, and it makes for interesting discussion. So I just want to thank everyone for their contribution in the session.
Yeah, and thank you so much to you too, Peter, for kicking off our Learning Month with Deloitte series. It's a great first start. And the ones to come, I think, will be awesome as well.
Josie, which one is the next one that's coming up? I can't remember. I got them all confused.
Yeah, you bet. So before all of you go, so there are 3 more sessions in our Deloitte series. The next one is next Wednesday. That's Financial Statements 101. The next one after that is the following Wednesday. That's Cash Flow Management. And then the last one is Tax 101. So for those of you who are interested in those topics, you can find more info at wesk.ca/events. And you all will be receiving an email from us tomorrow with the link to this recording. So keep an eye out for that one as well.
Awesome. Thanks, Josie, for having me. And yeah, again, thanks everyone for taking part. It was really awesome. Appreciate
Yes,
it.
thanks everyone for joining us. Have a great rest of your day.
Thanks. Bye.